Hi, I'm Rick Schwartz, one of the partners with Schwartz & Schwartz accounting firm. And on behalf of our firm and First National Corp, I'd like to welcome everyone to today's seminar. Before we begin, I'd just like to give you a little bit of background about our firm. Andrew and I started the firm approximately 1993, and we've grown over the years. Currently, we are about 20 people during the full year, and we employ about half a dozen seasonal staff this time of year where it's a bit busier. One of the things we've tried to provide to our clients over the years has been exceptional client service. Since our beginnings, we've focused on working with healthcare professionals, their families, and their practices. We try to offer a comprehensive menu of services for the convenience of our clients, which include tax prep this time of year that we focus on. We do accounting work for many of our practices, as well as payroll, and we do college and financial planning. Our goal with offering these financial boot camps is to help you become financially fit. And what do we consider financially fit? That's being well-informed, confident in your financial choices, and having a solid plan to reach your financial goals. We've worked with First National Corp for close to 20 years at this point. We have confidence in the work that they do and the value that they add to our clients as well. One of the reasons we've focused our work with First National Corp is that they're also focused on client service. Leading today's webinar is Alex Oliver, who's going to be the main presenter, and he's with First National Corp, been with them for a couple of years at this point, and is working towards his CFP. So without further ado, I'd like to introduce Alex and have him take over. Thank you, Alex.
Okay, thank you, Rick. Appreciate the introduction there, and thanks everybody for joining us on your lunch hour. So we can see about getting my screen on here. You should be able to have that now. Just confirm that. Okay, good. So yeah, again, my name is Alex Oliver. I'm with First National Corporation. We are a financial advisory firm. We have two sides to our business. One is in the private wealth management side. We work with a little over 450 families and individuals, managing their assets for a variety of different areas. So we do income tax planning in partnership with Schwartz & Schwartz. We help with estate planning. We help with investment management, managing IRAs or 529 college savings accounts, taking a very comprehensive look at the financial plan. The other half of our business is on the retirement planning side. So we serve as a fiduciary on over 50 retirement plan clients, so 401k or 403bs, all across New England. My background, as Rick mentioned, is going through the Certified Financial Planner program, which goes through these issues, but surprisingly doesn't really go through the student loan issue too much, which is what we're going to be talking about today. I think student loans has become a more prominent issue around the financial plan, I'd say in the last 10 years or so, with the higher cost of education. So we're going to really do a deep dive on this. This is our second edition in our financial wellness program, our boot camp. The first one was in regards to, it was called the Personal Finance Checkup, a quick and dirty personal finance checkup. We went over a lot of different topics there very broadly, but we didn't go and drill down on any of them. So this is the first of the next three that will drill down on these areas a little bit more. If you'd like that presentation, feel free to reach out to myself or Julianne, and we'll have our contact info at the end here to get that YouTube video for that first presentation. But this one will also be recorded so you can reference this later on. And I'll also note that there are a couple of handouts on here. You're welcome to save those and go back and put notes on the slides if you'd like to. Okay, so just before we get started, my quick disclosure here about consulting your own advisor or conducting your own due diligence before making any decisions. The topics, the strategies that I go over today are going to be very broad and should not be taken as personal advice. You will find out that there are many different kinds of scenarios that fit different people. So just because two people have $250,000 in loans at 7% interest does not mean that they're going to have the same financial plan, whether it's the same repayment program or same student loan refinancing. That'll be very clear as we continue to go along here. So just make sure that you do your own due diligence beyond this presentation. So just to give an overview of what we'll talk about today, number one, we're going to talk about how this fits into the overall financial plan. Again, I look at this as for many residents that are going on and now starting to earn a higher income, I look at this issue as to one of the building blocks. Again, if you looked at our last presentation 2 weeks ago, we have a set of building blocks, foundational blocks before moving on. So I certainly say this is one of them. We're going to talk about the various different repayment programs. We're going to talk about public student loan forgiveness and who that makes sense for. We're going to briefly talk about married filing separately versus married filing joint. That can make sense for some people, and I get that question a lot. So I want to talk about that today. And then we will talk about the goals of refinancing loans, what your different options are. We're going to go through, should I go through SoFi or CommonBond or First Republic? I will tell you my thoughts on that toward the end of the presentation. And then we'll also go through a case study to give you an idea as to a typical client I might work with and what we've done for them. Okay, so big picture here, again, this presentation will really be geared for medical professionals. And I've given this stat from the American Dental Association because, again, you are the kind of people that have extraordinary amounts of debt that can really feel quite overwhelming. It's not uncommon for me to see clients that have $600,000 or $700,000 if they're both medical professionals, and trying to figure out what to do with that. Especially considering that you may be buying a home that's going to incur a lot of debt. We'll talk also at the end of this presentation about the business consequences. If you're going to go buy a practice and take on another $500,000 in debt, there's a lot to think about there, and what order to do what in, we will discuss. That I do see a mistake sometimes just in regards to not completely thinking through what options you have or just not being aware of them. And so I think a lot of residents, as an example, might defer the student loan payments, go into forbearance, which typically is not the best option. And I'm going to, again, discuss that. And what that ends up leading to is a situation where we have two high-income professionals, or just maybe one high-income professional with a substantial amount of debt. Let's just say $1 million in debt that might be at 7% interest, accumulating $70,000 just in interest. That is not deductible because you make too much money to be able to deduct it off your taxes. It's a tough situation to be in. So we want to really make sure we put this into the financial plan. Just to emphasize this, again, if you were in my last presentation, you saw this slide about how this has been affecting college students, recent graduates over the last few years, delaying things like starting a family, having children, getting married, buying your first house. We'll talk a little bit about whether that's you should be tackling this issue or retirement planning, for instance. It's a headache to get your head wrapped around. So first thing I do when a new client comes to me, I'd say first is to check their credit. And again, we will talk about that a little bit more. But second is to assess their overall cash flow. So what are you making now? What do you think you'll be making over the next 2 years? What are your current expenses? What sort of leeway do we have between your income and expenses? Because if you're making, well into six figures, but you're also spending well into six figures on an annual basis, you just simply don't have as many options at your disposal, which will really affect your ability to grow your net worth. And so, I have a cliche on that first bullet point: living like a resident for your first 2 to 5 years out of residency. This means, trying to stay well within your means. Even if you're earning $300,000 or $400,000, trying to live off expenses that might keep you under $100,000. Seems crazy. I know that there's a cliche of doctors or dentists out there where they'll go and buy that big house or, buy that nice car. They've been in school for a long time. And now you have the resources to finally live the way you wanted to. I would just encourage you to postpone that for a little while, because you will see, again, if we want to refinance and get you with a higher monthly payment, it's going to pay off in a major way for the long haul. So trying to keep our expenses down, I think that's step number one. Building up an emergency fund, typically 3 to 6 months worth of expenses in case you were to go out of work for whatever reason. We want to build up a cash flow for that. We also want to build up cash flow for the student loan refinance, because they do look at liquidity So you don't want to just have, $2,000 in your savings account. Again, the student loan company will not necessarily look kindly on that when you try to refinance. So building up some sort of emergency fund, maxing out retirement accounts, huge issue for, again, high income professionals. You may be up at some of the higher tax brackets. We're in Massachusetts here, but we have a state income tax. You might be well into the 30% of your federal income tax. And so common question, should I be putting extra money, extra payments toward my student loans because they're at a high interest rate? Generally, I'm going to say no, because with a retirement account deferral, we are avoiding being taxed upwards of 40% on your deferrals. And once you're, again, 65, 70 years old and withdrawing this money at retirement, you're probably going to withdraw that at a much lower rate. You might move out of Massachusetts, go to a no income tax state. Your federal income tax rate will certainly be lower than it is today. So that's money on the table that, again, I wouldn't put money towards student loans. I would max out your 401k, your 403b. I would do things like a backdoor Roth IRA. I would contribute to a health savings account, all before making extra payments on the student loans. Okay, so we want to look at your cash flow after you've done those kinds of things. And then finally, I would look at your life insurance and your disability insurance. So, before we can go into this whole topic, we want to make sure that, as an example, if you're going to refinance your loans with your spouse, if you were to pass away during that time and now your spouse is on the hook for this big student loan burden and you don't have life insurance, they're going to be in rough shape if they don't make a similar income to you. So getting a term life insurance policy in place is a very easy way and cheap way to get rid of that risk. Same thing with disability insurance. Hopefully you can get a lot of this through your workplace right now, or if you own your own practice, you've installed your own policy there. But again, we have to make sure we have a steady cash flow before going too far down the student loan issue, okay? Because refinancing can take away some of our safety nets, if you will, okay? So, a lot of my slides here, just to give you a heads up, are going to have a lot of words on them. And, the reason for that is because this topic can be more complicated than you might have thought. And I want to make sure I outline exactly how some of these things work. Again, since this is a very broad presentation and you're all going to have different kinds of repayment plans, I want to go through them and make sure you have a takeaway here. And so first off, we'll start talking about government loans, okay? What do we do about them? This is talking about income-driven repayment. So when your income is very low compared to a very high student loan balance, most people will go through some sort of income-driven repayment plan that caps what their monthly payments are going to be. Regardless of if you have $100,000 in loans or $500,000 in loans, they'll typically limit your payments to, say, 10 or 15% of your non-discretionary income. They have a whole formula that goes at the current poverty level and your current family size, which says here's the maximum that you're going to have to pay back on this. Getting on a payment plan is really important on government loans when you're first starting out. And there can be a lot of confusion on this topic because it used to be PAYE, pay as you earn, and income-based repayment that existed, and a lot of people are still on those programs. But in 2015, a new program came out called RePAYE, which stands for Revised Pay as You Earn. And most people will end up using this, but again, I will explain a situation where you may not. That is going to be a huge part of the overall financial plan. Keep your payments low, potentially get forgiveness for those that maybe are not earning a lot of money. It may make sense to do that, but I'd say most people, their incomes are going to rise so fast that they will not have a forgiveness because their required payments are just going to outweigh what that would end up being. Okay. RePAYE, let's hone in on this one in particular, because again, I think I see this mistake too many times where a resident might be going into forbearance or deferment on their loans, and they may miss this really important part of RePAYE. So not only does it cap your monthly payments to allow you to have cash to live and pay rent and all those kinds of things, the government will actually also subsidize part of the interest on your loan for the first 3 years that you go into the RePAYE program, okay? So just to kind of bring you through this here, I've given you an example. Basically, if you've gotten your payment down to about a $200 payment per month, but your loans are so large that you're accumulating about $1,000 in interest per month, that difference of $800 essentially, the government is going to add only $400 of that interest to your overall loan balance. The other $400 is completely waived. You don't have to pay it at all for those first 3 years, okay? That is a huge benefit. It essentially cuts your interest rate almost in half because of that little provision, okay? So again, not necessarily a good idea to go into deferment or forbearance where the entire loan is still being there, while here, again, part of that interest is being waived, okay? I'll also just cover these last couple of paragraphs quickly. The government's also going to cover about 50% of the accrued interest charges on unsubsidized loans throughout the RePAYE payment period. Another nice little benefit there. But if you do end up leaving RePAYE, again, because your income has risen, your interest is going to start capitalizing. And so you'll then at that point want to start thinking about refinancing the loan, okay? I've just given you a quick resource here as far as just repayment programs. Student Loan Hero is a website, and I think this particular website, again, the slides are attached here at the handout. Go copy and paste this link, and you will get more reading on student loan repayments than you could dream of. So I think that's a nice resource there to have. Okay, another topic that may not be applicable to everybody here, but I want to make sure we cover it very quickly because this one definitely requires some student loan planning. If you're currently working in the nonprofit sector, or if that's what you aspire to be if you're currently a resident, you probably already know that there's a student loan forgiveness program that if you work for a 501c3 nonprofit and you certify every single year, your loans will be completely forgiven tax-free after 10 years. So a little incentive given by the government to try and steer you toward those kind of jobs that might pay you less than you would have gotten in the private sector. And there are many calculations out there that will help you figure out, does this make sense for me? But if you have a large loan balance, there's a lot of cases where taking a lower salary, paying lower taxes will make sense to get this forgiven. Again, if you want to go into the public sector. So, if you can afford the monthly payment, basically, RePAYE is usually the best way to blend this public student loan forgiveness issue. We want to make sure we get a low monthly payment, again, since we know that we're going to try and get this forgiven. Much easier to project if you're already 5 years into the nonprofit. You've already gotten 5 years of nonprofit work experience than if you're just starting out. But if you're 5 years out, again, we want to keep payment low, potentially file separately and pay more taxes. I'll run you through an example on that. So that way we're not throwing more in monthly payments every month that we're, again, going to end up getting forgiven. If you don't decide to do the public student loan forgiveness, even if you've already got a few years in and you've just decided this is not for me, again, a private refinance is going to be something that you're going to want to do as soon as possible, lowering your interest rate and getting the shortest term possible. So let's talk a little bit about the married filing separate issue very quickly. Again, I've run through many scenarios, and I'd say out of the scenarios that I've run, maybe 2 in 10, this makes sense. And so I want to just give you an example of where it might make sense for you. Again, this is only for public student loan forgiveness. So if that's not your issue right now, you can tune me out for about 2 minutes here. But essentially, you want to run a calculation of a break-even analysis. You want to look at your current tax brackets on the married filing joint and the married filing separate and see what your tax liability is going to be under each scenario, okay? This is going to be a very simple example because we're not going to go through certain deductions that you might have and whatnot, especially if you're a business owner. Again, this could be very complicated. But I would go to these tables and, let's just say, married filing joint, you make exactly $400,000. You know that you've got a tax liability there starting at $91,000, and then anything over that, if you make 405, it's 35% of that amount over the 400. That's how you calculate your tax burden on a very, again, broad, simplistic level. So where does this make sense? Where does it make sense to file separate? Let's take a look at it. Two examples here. A couple that makes one makes $400,000 and the spouse makes $77,000 versus a couple where they each make the same amount of money. You will notice that if you add these two together, they add up to the same exact amount of money. But they have different tax burdens. On the first one, where one makes vastly more than the other, married filing separately is going to incur a tax that costs them $12,000 more. Okay, so that's a significant amount of money. I mean, that's a lot of money to be paying to the IRS. So if you've got a wide gap in earnings, it may not make sense. Again, typically what's happening here is this person has a lot of loans that's making $400,000, and this person has zero loans. So they're trying to figure out, do we file separately to keep our payments low and get public student loan forgiveness, or not? Whereas in this scenario, it might make a little bit more sense because they're making the same amount of money. If you go and look at those tax tables, married filing jointly, this is what their tax is going to be. But if they married filing separately, this is still what it's going to be. It's going to be the same amount. So in that case, yeah, again, you may lose some deductions. You may lose the ability to, contribute to certain retirement accounts. But if you can keep your payments low and you're 2 or 3 years away from getting those loans forgiven because you've been in the nonprofit sector, that's where it really makes sense. And so I know I've talked to the tax advisors at Schwartz & Schwartz, and they do a great job of very quickly analyzing your situation. Okay, what happens if we married filing joint or married filing separately? So you don't necessarily, if you're already a client of Schwartz & Schwartz accountants, or if you have a good accountant of your own, you don't have to go through this yourself. You can go to them and say, what is my tax liability given my situation? And then either on your own or with an advisor like myself, we'll have to start figuring out, does it make sense to, take a lower salary to work in the nonprofit sector, pay the extra taxes, and get it forgiven? That's just an answer that most times it's going to make sense to do married filing joint. But again, if you're 7 years into the nonprofit sector, you really want to take a hard look at this topic. Okay. So again, I know that is a issue for a very small amount of people, but a huge issue for those people. So I appreciate you hanging around for me on that. Okay, let's get moving on. The refinancing issue, probably what most people are thinking about. Certainly with private loans, anything that's, I say as a rough rule of thumb, if you've got interest rates over 6%, typically 6.8 or 7.9%, you're going to want to think about refinancing these and getting these down. So the first step is to prepare you before going into the refinancing process to make sure you have as good of a standing as possible before getting your credit pulled. So a year or two out, we want to kind of look at these kinds of things and figure out where you stand. So again, if you looked at my presentation from last time, you saw this chart. Just a couple of quick things. You'll want to go to creditkarma.com, pull your credit score, and make sure you're paying all your payments on time. Credit cards, auto loans, your student loans, obviously. And at the same time, I also discussed in our last presentation, increasing your credit limits to try and increase your score. Just as a brief recap on that, if my credit cards give me $30,000 in credit limits and I'm only using $1,000, I look, very good to them because they've given me all this money and I haven't used it, so I'm probably pretty credit worthy. Now imagine instead of $30,000 in credit limits, I've got $100,000 in credit limits. Now I'm only using $1,000. That's 1% of my overall credit limit. So a very easy trick, again, if you're 6 or 12 months away from refinancing, is to call Visa, call MasterCard, call Discover, and just ask for an increase in your credit limit. And that will short-term hurt your score, but long-term help you out. So again, that's why you'd want to be 6 months or a year away from refinancing and just doing this in preparation. I mentioned the issue with co-signing and where life insurance plays into that. So, that's just to reiterate, that's a really important thing before going down this road. Okay, so let me get to a quick case study here. Again, this is a handout that we have, but I think it's a really, again, typical scenario that I run into all the time that you can probably relate to in some way, shape, or form. So this is Kathy and Jeremy. right now they're pretty young, and right now their combined income is fairly low. He's a dentist and she's a physician, so they will have higher incomes in the very near future. But for right now, they've only got 150 grand, and they've got $600,000 in debt. And so, they're in their early 30s. They're just graduating, going through residency. They just had a 7-month-old, or they just had a son, and he's 7 months old now. And they're trying to figure out, what do we do next? They've got a lot of different things they want to do. They want to obviously, raise their child, help saving for college. They want to go buy a house eventually, but again, they don't know what they're supposed to do. So in our financial plan, again, I'm always going to start with risk management, just as I did in this presentation, talking about emergency savings, disability, and life insurance, and do a full review of what they have and where they have gaps. In their case, they looked okay as a whole. I think Jeremy had disability insurance that had a 180-day elimination period, which means that they would not pay him for 180 days or 6 months until he filed a claim, which means, in his case, he's really going to need to get a good emergency fund in place. Usually disability insurance is going to have a 90-day elimination period. So that was a unique case of making sure we got emergency funds established. But, it turned out that they did not have life insurance yet, or at least had small policies of maybe one-time salary at their current workplaces. So, we recommended that they go take out $1.5 million 30-year term policies, which were very inexpensive, but would, help them to now approach the student loan issue and say, okay, we're good with refinancing. If one of us passes away, we're going to be okay with that student loan burden taken care of because of the life insurance. If we buy a house, that $500,000 mortgage, if you will also be able to be taken care of because of that life insurance. So that's a very, again, typical recommendation. Okay, so we get that all in place. Now we can start to talk about the student loans. They had very high interest rates, 7.9% here. Again, a low combined income. So we found out that after going through the companies, refinancing was not going to make sense because the monthly payment that came out from that refinancing quote was way too high. They just wouldn't have been able to afford it. So instead, we had to do a little bit of a combination of strategies. And again, look at their credit. So Jeremy had a strong credit score. He was at 750, but he was only making around 60 grand at the time. So we definitely needed Kathy to be in on this loan. She made 90 grand, but her credit score is lower. So, okay, well, what do we do about that? We have to figure out how to get these both, up to snuff here. And the funny thing about the situation was a very small factor brought Kathy's credit score down. They had bought a mattress. A lot of people would buy a mattress for their home, brand new mattress. I think it was a $3,000 mattress with a 0% interest for up to 36 months, which at the time is a great loan. I mean, 0% interest for 36 months, as long as you pay it off in the 35th month, you're going to be okay. However, what this did to them was they had given a credit limit of $3,000, but they were using that full credit limit of $3,000. And that brought down her credit score because she was using 100% of her available credit. So what we recommended they do was just to pay it all off almost. We left a $500 balance. So she put $2,500 toward the loan, and her credit score went from 680 to 732. Okay, and she increased the credit line, and we waited a couple of months before going for a refinance, and now all of a sudden we look great to the refinancing company. So again, these are all things that I'm helping them go through. So we made a few soft inquiries. Don't want to go and just make a hard pull on our credit for a company that we're not going to end up refinancing with. So we want to just kind of get some quotes. I think we went to 3 different lenders. And we got one interest rate. Our lowest interest rate was 5.6 from CommonBond. I think SoFi gave us a 6.8% interest rate. So they can vary. I mean, over 1% between those two companies. So we ended up going through CommonBond. But again, we also use the revised pay-as-you-earn program for those government loans. Because, if we had the income, we would have just refinanced it all. But we just didn't. In 2 years, we will. And we will revisit this topic. But at the moment, We didn't. So it was a combination of RePAYE and a refinance. Okay. In a few years, we will probably go back to a different lender, not CommonBond, because based on your life stage, I'd say each of these student loan companies specialize in different kinds of people, and we'll talk about that here in a second. I think the final thing I want to note here is that, again, this is a comprehensive financial plan. So as I mentioned earlier, we are making sure they max out their retirement plans, but because they also wanted to buy their first home within a year or two, we started them saving $1,200 a month toward a conservative investment account using low-cost ETFs with no transaction fees, very cheap, and they eventually got to their down payment amount and were able to purchase their house about 3 or 4 months ago. So again, this is just a nice case study to figure out, how do we learn to live with the student loan? How do we make it part of our plan? As you can see, we're not throwing extra money toward the student loan. We're figuring out, what are we going to get it down to, and then what do we do with the rest of the financial plan? Do we put the money toward retirement, our home down payment, our college savings accounts? Again, it's gonna depend based on your situation and what we can get as far as a RePAYE amount or a refinance. Okay, so I hope that kind of gives you a little just perspective as just to how in depth I would look at a situation before really making a call on what you should do. Okay. All right, so let's wrap it up here. If you do decide to go it on your own and you've kind of looked at all this and just said, I know I got to refinance something, I would encourage you to look at these top options for student loan lenders. So with any client I have, my very first consideration is First Republic Bank. Luckily, this is a bank that only will refinance for those customers that live within a certain distance of one of their banks. I'd say there's 6 or 7 states in the United States that they are able to refinance with, or residents that they're able to refinance with, and Boston, Massachusetts just happens to be one of them, luckily. And they are very well known in this space for offering very low rates. Okay, you can see this is about 2 weeks ago. They still had an offer of 1.95% fixed interest. That may have gone up in the last couple of weeks because interest rates still have started to go up. But regardless, it's definitely typically 2 or 3% lower than anybody else. So you would want to start thinking about them. They require you to have at least $40,000 in a balance. They require you to have a 750 credit score or more, and they require 24 months of work experience within your industry. Okay, and if you're in a specialty, within your specialty. So they want to have a really good idea that you're a credit-worthy person before going to them. And to be honest, as of the date of this webinar, I have yet to have a profile that they have accepted and actually refinanced with. So I hope maybe we can find somebody that does that, but they have very high standards. Some people get a little thrown off by this whole checking account thing. A lot of banks do this now. They want you to have all your banking done with them, and they might balk at that. I would say, for First Republic Bank, if it was a difference of 0.3% on the interest rate, then maybe it's not worth it. But in their case, it's a significant difference than the other lenders out there. And so I would certainly be open to moving all of my banking to First Republic Bank to get that lower rate if you qualify. Okay. So just these other options here. CommonBond, for whatever reason, has been a great success story for us at First National. Again, we've quoted at many different companies, but CommonBond has consistently come in at the lowest rate, but that doesn't mean that's always going to happen. So these things change all the time. I would consider them. If you are a dentist and you're part of the American Dental Association, you're going to get a 0.25% discount at Laurel Road. So I would think about that. And then a few other very common companies here, Earnest, SoFi, and LendKey. I wouldn't say there's anything really special about them. I do believe Earnest has this very unique thing where you can actually say, I want to make a monthly payment of $3,000 per month. And then they'll come out and they'll tell you, okay, well, this is the interest rate and the term that we're going to allow you to do that with. So if you're kind of one of those people that really watches cash flow and you want to go at it that way, Earnest might be the right company for you. But either way, I would just do some soft inquiries with some of these, get your balance sheet together, get your cash flow together, get your credit scores together, get your last tax return and figure out what your income ended up being, and you can go to them and they'll give you a good idea as to where you might fall. The last note I'm just going to have on this, you can see I've also put email Alex in regards to referral codes. There's a website out there. All these companies have affiliate links, so if people refer them, they will pay out a dollar amount, say $500 or $200 as a bonus for refinancing. I don't get paid anything on this. These are just referral links that I've found over the course of doing this research. So shoot me an email if you're thinking about refinancing with one of these companies, and I'll be able to send you that link, which again, is just another, say, $300 or $500 on top of, what lower interest rate you might get. So I would encourage you to get in touch with me if you're going down that road. Okay, very last topics here. Again, very small amount of people that may be needing this conversation, but for, let's just say, a dentist that is coming out of school, either going into residency or not, and they're trying to figure out, okay, I've got $500,000 in student loans. Do I now go and purchase a practice, or do I buy a house with the loans, or do I pay off the loans? What do I do with this extra income? And as I've alluded to before, a couple of things I would think about. First, I would recommend buying the practice before buying the house in most cases. There is a significant earning difference. And again, I'm just sticking with dentists for right now. You'd have to apply this to your own profession if this is the route you're going to go. But there is a significant difference from a business owner dentist and a general dentist in a practice and what you could make. And so, I'll typically encourage you to go down the practice route before buying your house. And I would encourage you to do that because, buying a practice and getting approved for a loan might be a little more difficult for that than buying the house. And buying the practice comes with a lot of expenses, a lot of planning needed. You're going to have to set up a whole payroll. You might have to put in a retirement plan. I mean, there are just, disability insurance, a lot of things to go into. I would want to get that all done before going down the home purchase route, so you know exactly what kind of cash flow you need, and you can choose the size house appropriate for you at that point in time. So typically practice before home. And then I think another thing that you'll want to think about is liquidity. As I mentioned before, a lender will rather you have $100,000 in cash and $400,000 in student loans than zero cash and $300,000 in student loans. So in that example, same net worth, okay, but different amount of liquidity. So again, they want to make sure before they give you a bunch of money that if you have a month where you just don't have as many clients as you thought you were going to, you're not going to miss payments all the time. So I think liquidity, again, is going to be a huge deal here before paying off a 7 or 8% interest rate. So that's, again, a unique situation. And then finally, I've already gone through my whole thing on the tax bracket side of things, but if you're a high income earner, you're going to want to think about maxing those out before, again, going back to the loans. So, that really wraps us up here. Just to give you a quick summary, some quick takeaways for you. I would say if you're in training right now, again, as a resident, you're going to want to look at that revised pay-as-you-earn program. If you're an exception, you're going to want to talk to maybe a lawyer or some other student loan professional that does this full time. But again, most people should do RePAYE, keep their payments low. If you're training, you're going to want to refinance those private loans because again, RePAYE does not cover private loans. So refinance those to the best that you can. And then once you get done with your training, if you go through public student loan forgiveness, you're going to want to make sure you certify that every year. There's a lot of conversation in politics these days about ending the public student loan forgiveness program, which gets a lot of people afraid of going down that route. I'd feel pretty confident that if you've certified 6, 7, or 8 years, you're going to be grandfathered into that whole process. But, if you've gone 7 years and you haven't certified, I can't tell you what's going to happen at that point. So make sure you certify with the federal government that you've been working at a nonprofit if that's on your financial plan. And then finally, again, if you're not going to go through public student loan forgiveness, refinance the loans, Try to have them paid off within 2 to 5 years, maybe, especially if you're going to be working at a hospital for many years. But again, I caveat that if you're going to be a business owner, maybe not. You're probably going to have to live with these loans for quite a while and just try to get the lowest rates possible. And then finally, I can't emphasize enough, trying to live like a resident, keep your expenses low. The world is going to be your oyster in 5 or 10 years, but these first few years, you want to give yourself a lot of chances to build liquidity and build your net worth as fast as possible. Okay. Well, I thank you for joining us today. This is our website, fncadvisor.com, First National Corporation. Again, we've been in business now for 30 years, and we are comprehensive wealth managers and helping with these issues to see the big picture and see what you're trying to do. So feel free to reach out to us and learn more about us. You can also send me an email if you'd like to join our newsletter. We'll have random blogs and random comments on the market. If you want to learn a little bit more about our perspective and see if our line of thinking is in line with yours. And here are our links here. I think I would encourage you to go visit our blogs, see some of the articles that we've written. I think a lot of them might be applicable to you if you're coming to this presentation. And my points of contact, I do publish those blogs on LinkedIn. You can always contact me at that email and feel free to give me a call as well. Okay. Well, I hope everybody enjoyed the presentation today. Again, thank you for joining. And I look forward to seeing you at our third and fourth webinars here in the next few weeks. Thank you again.